Hi, this is Jay Rosenberg of Rival Capital Management with our Q3 2007 investment review and update. Third quarter of 2007 was a wild, volatile, and ultimately profitable one for investors in the end. A few times during the quarter I sat down to write a mid-quarter update, only to see things shift dramatically, sometimes hour to hour in the market. I therefore decided to hold off drawing any conclusions to investors and spent my time in the more important task of assessing each client account, evaluating risk, and most crucially looking to add long-term investments, selling at sharply lower prices caused by the panic. The result, I am happy to report, is that all discretionary accounts are up for the year at an average rate of 8.5%, almost a percentage point above the year-to-date return of the S&P 500 index. Volatility was certainly higher than previously experienced, but according to the science of investing, that volatility is often the price we pay for healthy long-term returns. The question is how to handle the volatility. Do you look to unload positions and simply stop the pain of declining net worth, or do you look for new investments to add to your portfolio and only prune those other investments whose long-term outlook seems to be permanently impaired? Professional investment management in general, and Rival Capital Services in particular, can be of great use to investors during turbulent times, serving as a buffer between an investor's passing emotions and a long-term approach that should be adhered to. That is not to say clients did not communicate with us regarding their concerns, but during times of stress the Rival Capital approach has worked, hopefully providing further reassurance in future difficult times, which are as likely as a cold day in January. So what were we watching and buying in the third quarter? A mix of fast-growing but attractively priced technology stocks, multinational industrial and manufacturing companies continuing to benefit from a vibrant world economy, undervalued healthcare stocks, the same energy and material stocks that have driven performance for the past 3 years, and beaten down financials that are not existentially threatened by the subprime implosion. That is certainly a lot of stocks to choose from, which is precisely the point. The stock market's panicky sale and 10% correction was in fact the best time to initiate long-term investment positions as long as there was a margin of safety and a good probability of long-term future gains because of a present undervaluation. We were there every day to be opportunistic on our clients' behalf. To sum up, the summer of 2007 was a reality check on investor behavior and expectations. Those that kept their heads came out wealthier and most likely with better, more diverse long-term portfolios. It's also worth mentioning that some of the leading hedge funds during this period, so-called quant funds designed by Wall Street's best and brightest, got absolutely annihilated during this period and were forced to sell during the worst of all times. Although it would be nice to believe in black boxes that could spit out market-beating returns based on numbers alone, the summer's results show that personalized and human case-by-case analysis of investments and portfolios still has a lot to offer, an organic approach to investing that Rival Capital continues to practice. We thank you for your continued confidence and ask that you consider referring to us any individuals who could stand to benefit from our steady approach that has now proven its effectiveness in both good times and more challenging ones. Enjoy the autumn.